Hi, this is Geoff Johnston, Senior Portfolio Manager at Empire Life Investments. The Fed has just hiked rates by 25 basis points, and that is the second hike they've done so far this year, and that brings the Fed funds rate to 1.25%. Now, there is some concern out there in the markets about these rate hikes and what that means for equities as well as bonds. And a lot of people are worried about it, but we think these rate hikes are actually a positive development. We have our 5 top reasons why these Fed rate hikes are positive, and I'm going to go through them now, so get your pen and paper ready. Number 1, the Fed rate hikes are a sign of confidence in the financial system and in the economy in general. Now, we know that Fed Chairman Yellen is a very cautious person, and she would not hike rates unless she was quite certain that the economy and the markets could withstand it. So that's definitely a good sign. Number 2, the Fed rate hikes provide some dry powder. Now, if the economy were to turn down, and we don't think that's going to happen anytime soon, but if it were to turn down and rates were still at very low levels, there wouldn't be much the Fed could do about it. They would have no ammunition to try and battle that. So the fact that they've raised rates a few times gives them some ammunition in the event that the economy does turn down. And hopefully they will hike a couple more times at least to give them even more ammo. All right, that's number 2. Number 3, it provides a bit of certainty. As you know, the markets hate uncertainty, and there was definitely some question mark there for a while about whether the Fed would go or whether they wouldn't go. They were dragging their feet a little bit, but now they seem to be on a very clear path with these rate hikes, and so the market can prepare themselves for it, and as I think they have, they seem to be taking these hikes in stride for now. Number 4, and you may not hear this one too many other places because it's a bit of a contrarian perspective, but I would argue that Fed hikes are actually stimulative because higher rates means that the government is paying a higher cost on its debt or higher rates, and that means increased spending. So the increased spending is stimulative. It's just Keynesian 101, higher government spending due to higher rates. And finally, it's number 5. It's just nice to have some normalcy. There was after the rates have been so abnormally low for so long, it is frankly a bit of a relief to have rates come back to a little bit more normal levels, especially for us on the bond market. As you know, it has been quite a challenge to get decent yields on our bond portfolio. So higher rates should help that. Now, higher yields means lower bond prices, so the existing portfolio will have subdued price movements, but it shouldn't be anything too significant as long as these rate hikes are fairly slow and gradual, and that's what has been happening, and that's what we think is going to happen in the future. So the bonds should be able to handle it very nicely, as will stocks, and it will be nice going forward to be able to put some money to work in the bond market at some higher rates. So there you have it. There is our top 5 reasons why these Fed rate hikes are positive. And thank you for listening.